Most people think the 2008 financial crisis was caused by greedy bankers, irresponsible homeowners, and a housing market that got too hot. And that is true, but it is also the baby version of the story, because the real story is much worse. The 2008 crisis was not just a bunch of people buying homes they could not afford. It was not just banks making bad loans. And it was not just Wall Street accidentally pressing the wrong button on the financial system. It was a giant machine, a machine that turned ordinary mortgages into luxury financial products, turned risk into something nobody could recognize, and turned the American dream into a ticking time bomb. And the craziest part is this: almost everyone involved had a reason to keep the machine running. The homeowner wanted the house, the mortgage broker wanted the commission, the bank wanted the loan off its books, the rating agency wanted the fee, the investor wanted the yield, and the government wanted everyone to believe the economy was fine. So for a while, everyone got what they wanted, until the bill arrived. And when the bill arrived, it was not paid by the people who designed the machine. It was paid by the entire economy. To understand 2008, you have to start with one simple belief: housing always goes up. That was the bedtime story. For decades, houses were not just places to live. They were symbols of success, stability, adulthood, and financial intelligence. Buying a home was treated like the final level of responsible life. Get a job, save money, buy a house, build equity, retire happy. It sounded safe. It sounded normal. It sounded like something your uncle would explain at Thanksgiving while holding a beer and pretending to understand interest rates. And for a long time, it worked. Home prices generally rose. Banks made money. Homeowners built wealth. The system looked stable. But there is a dangerous moment in finance when something that used to be reasonable becomes a religion. And by the early 2000s, housing had become a religion. People did not ask, "Can this house fall in value?" They asked, "How much can I borrow before someone stops me?" And unfortunately, nobody stopped them, because the banks had found something magical. They realized they did not actually need to hold the mortgages they created. In the old world, a bank made a loan and then had to care whether the borrower paid it back. Very boring, very responsible, very bad for quarterly profits. But in the new world, banks could make the loan, package it with thousands of other loans, turn that package into a bond, sell it to investors, and move on. This was called securitization, which is a very fancy word for taking a pile of questionable mortgages, putting a nice label on it, and selling it to someone wearing a suit. And this changed everything, because once banks could sell the loans, the quality of the loans mattered less. The question was no longer, "Can this borrower repay?" The question became, "Can we sell this loan to someone else before reality notices?" That is how the mortgage machine got started. Mortgage brokers were paid when loans were created, not when loans were successfully repaid. So they had every incentive to approve more borrowers. Banks made money packaging the loans, so they had every incentive to demand more mortgages. Wall Street investors wanted higher returns, so they had every incentive to buy more mortgage-backed securities. And rating agencies were paid by the same institutions whose products they were rating, so they had every incentive to look at a pile of risky loans and say, "Looks safe to me." This is where the comedy becomes a horror movie, because the financial industry did not just sell mortgage bonds, it sliced them into pieces. The safest looking pieces were called senior tranches. The riskier pieces were lower tranches. In theory, this made sense. Different investors could buy different levels of risk. In practice, it became financial lasagna. Layer after layer of debt, sauce, optimism, and denial. Then Wall Street went even further. They created CDOs, collateralized debt obligations. These took pieces of mortgage bonds, bundled them again, and sold them as new securities. So now you had products built on mortgages given to people who maybe should not have been approved in the first place. It was like building a skyscraper on sand, then selling tickets to the observation deck. And somehow, a lot of these products still received AAA ratings. AAA, the same rating normally reserved for extremely safe investments, the financial equivalent of putting a seatbelt sticker on a car with no brakes. And investors bought them. Pension funds bought them. Insurance companies bought them. Banks bought them. Foreign institutions bought them because everyone wanted yield. Interest rates were low. Safe assets were boring, and mortgage products looked like the perfect solution. Higher returns, low risk, backed by housing. What could possibly go wrong? Well, the answer was hiding inside the mortgages themselves, because during the housing boom, lending standards collapsed. There were subprime mortgages made to borrowers with weaker credit. There were adjustable rate mortgages where low teaser payments later reset higher. There were interest-only loans. There were low documentation loans. There were even loans where borrowers barely had to prove income. The industry had discovered that if housing prices kept rising, none of this looked like a problem. If a borrower struggled, they could refinance. If they could not refinance, they could sell the house. If the house kept rising, everyone survived. So the entire system depended on one assumption: home prices could not fall nationally. That was the load-bearing wall. And then the wall cracked. Around 2006, U.S. home prices started weakening. At first, it looked manageable. Just a cooling market, just a small correction, just a little financial flu. But then adjustable mortgage payments began resetting higher. Borrowers who were barely surviving on low introductory rates suddenly faced payments they could not afford. Defaults rose, foreclosures increased. More homes hit the market, more supply pushed prices lower. Lower prices made refinancing harder, and harder refinancing created more defaults. That is the feedback loop. Falling home prices created defaults. Defaults created forced selling. Forced selling pushed home prices down further, and the machine that looked genius on the way up became a trap on the way down. This is the part people often miss. The crisis was not just that homeowners defaulted. The crisis was that the financial system had multiplied those defaults across the entire world. A single bad mortgage was a problem. 1,000,000 bad mortgages were a disaster. But 1,000,000 bad mortgages hidden inside complex securities, leveraged by banks, insured by derivatives, and held by institutions across the planet. That was not a housing problem anymore. That was a global financial bomb. And the banks were standing very close to it, because large financial institutions were not just selling these products. They were holding them. They were borrowing against them. They were using leverage. And leverage is simple. It makes good times look brilliant and bad times look fatal. If you invest your own money and lose 10%, that hurts. If you borrow heavily and lose 10%, that can erase you. By 2008, parts of Wall Street were so leveraged that small losses could create massive damage. Then came Bear Stearns. Then came Lehman Brothers. Then came panic. Lehman filed for bankruptcy in September 2008, and the financial world basically looked down and realized there was no floor. Credit markets froze. Banks stopped trusting each other. Companies had trouble borrowing. Investors ran towards safety. Stock markets plunged. Retirement accounts got crushed. Unemployment rose. Businesses failed. Ordinary people who had never bought a CDO, never worked at an investment bank, and never lied on a mortgage application suddenly found themselves paying for a crisis they did not create. That is when the phrase, "too big to fail," entered everyday life. And "too big to fail" is one of the most honest phrases in finance, because it basically means this institution made decisions so dangerous that letting it collapse might destroy everyone else too. So now we have to save it, not because it deserves saving, but because the alternative is worse. This is what made the crisis so infuriating. In a normal system, failure punishes bad decisions. But in 2008, the bad decisions were so deeply connected to the rest of the economy that punishment became contagious. If one bank failed, it could hurt another bank. If banks stopped lending, businesses could not operate. If businesses cut jobs, consumers spent less. If consumers spent less, more businesses failed. The crisis spread through the economy, like spilled ink in water. And suddenly the public was told that massive bailouts were necessary. The government introduced emergency programs. The Federal Reserve stepped in. Banks were rescued. Markets were supported, and millions of ordinary people were left wondering how the same system that privatized the profits had somehow socialized the losses. Because during the boom, the gains were private, bonuses were private, fees were private, commissions were private. But when the machine broke, the damage became public. That is the part that still matters. The 2008 crisis was not just a story about housing, it was a story about incentives. When brokers are rewarded for creating loans, they create more loans. When banks are rewarded for packaging risk, they package more risk. When rating agencies are paid by the people selling the products, ratings become suspiciously generous. When investors chase yield without understanding the product, complexity becomes a disguise. And when institutions know they are too important to fail, risk-taking becomes easier. That is the moral hazard. And moral hazard is not complicated. It means people behave differently when they believe someone else will absorb the consequences. Imagine a teenager borrowing your car after you tell him, "Do whatever you want. If you crash it, I'll pay." Congratulations. You have just invented Wall Street. Now meet Dave. Dave bought a house in 2005 because everyone told him renting was throwing money away. His mortgage broker told him not to worry about the adjustable rate because he could refinance later. His neighbor bought 2 investment properties. His cousin became a real estate agent. His coworker made $80,000 flipping a condo and suddenly started speaking like a property guru. So Dave bought. At first, everything felt great. The house went up. Dave felt smart. The bank felt smart. The broker got paid. The investor holding the mortgage bond got yield. Everybody clapped. Then prices stopped rising. Dave's payment reset higher. Refinancing became impossible. The house was worth less than the mortgage. Suddenly, Dave was not a homeowner. He was a hostage with a lawn. And Dave was not alone. Millions of people were trapped in the same machine. Some were reckless. Some were misled. Some were unlucky. Some simply trusted a system that looked official enough to be safe. And that is what made 2008 so brutal. It mixed personal responsibility with institutional failure so perfectly that everyone could blame everyone else. Banks blamed borrowers. Borrowers blamed banks. Politicians blamed regulators. Regulators blamed innovation. Wall Street blamed models. And the models, very conveniently, could not testify in court. But the uncomfortable truth is this. The 2008 crisis happened because the entire system became more profitable when it ignored risk, not because nobody saw danger. Some people did, not because the math was impossible. It was not. Not because housing was magical. It was not. The crisis happened because too many people were paid to keep believing a story that stopped making sense. Housing always goes up. Risk can be sliced away. AAA means safe. Liquidity will always be there. The music will keep playing. And then one day, the music stopped. This is why 2008 still matters, because every financial bubble has a different costume, but the same skeleton. First, there is a believable story. Then there is easy money. Then there is rising price. Then there is social proof. Then there is leverage. Then there is complexity. Then there is denial. And finally, there is the sentence that appears right before everything breaks. Nobody saw this coming, but usually somebody did. They were just early, or ignored, or mocked, or not profitable enough to listen to. So what should ordinary people take from the 2008 crisis? Not never buy a house, not all banks are evil, not the economy is fake. The real lesson is sharper than that. First, when an investment only works if prices keep rising, you are not investing in safety. You are investing in momentum. Second, when a product is too complicated to explain simply, complexity may be hiding risk. Third, when everyone in the chain gets paid before the outcome is known, the system is probably designed to create volume, not quality. Fourth, when institutions say something is safe, because a model says so, remember that models are just spreadsheets wearing confidence. And fifth, when everyone believes the same thing at the same time, that belief becomes dangerous because markets do not usually break when everyone is scared. They break after everyone becomes comfortable. That was 2008, a crisis built on comfort. Comfort that housing could not fall. Comfort that Wall Street had spread the risk. Comfort that ratings meant safety. Comfort that liquidity would always exist. Comfort that the smartest people in finance knew what they were doing. And maybe that was the biggest illusion of all, because the financial system was not destroyed by stupidity alone. It was destroyed by intelligent people following broken incentives. That is scarier. A stupid system is easy to mock. A smart system with bad incentives is much harder to stop. And that is why the 2008 crisis was not just a mistake, it was a warning. A warning that when profits are immediate, risks are delayed, and consequences are shared, the machine will keep running long after it should have been turned off. So now the question is simple. Was 2008 mostly caused by reckless borrowers, greedy banks, or a broken system that rewarded everyone for pretending the risk was gone? Choose one in the comments. A, the borrowers, B, the banks, C, the system, because depending on your answer, you might see the entire crisis differently. Thank you so much for watching. Please comment, like, and subscribe if you like our video. Hope to see you again.